Good morning. My name is Don Vivrette. This is Financial and Estate Literacy. It's your money for the fall of 2022-23. That time moves on. We're having some bumpy day today, folks. First session. Okay. I want to just touch on a couple of things while we are here. You have in the email that you got that described what all's going on, down near the bottom of it, I believe it also tells you how you can get the material for today. One of the things that's in there is I did a workbook a couple of years ago. We've refined it slightly along the way. If you go in and download the workbook at this spot in terms of the workshop articles, you can, excuse me, download this one. And I'm going to go one more, and then I will show you where all of these are. The other thing that we've done is you leave me alone for too long and I'll do something. So wrote a couple of booklets. They're like 30 pages long or something like that. And they're interesting from the standpoint of giving you just ideas. They're outside of what we do in this session, but they're interesting in terms of what's happening. I'm going to switch screens and I'm going to go to here, share this. So if you're on the website, if you click on workshops and you click, for instance, on It's Your Money, which is what we're doing now. Clicking on It's Your Money, love live demos. So if you scroll down here, there's a thing that says General Workshop Documents. So there's the workbook, and there are the three booklets that are available, and also a blank Ask First form, which Pete might talk about. So any of that information is available here. It's easy to get to and is available at any time. The only other thing I wanted to do, Pete, is to do, oops, I need to reshare. Share. Let's go back to here. Share. So what we're going to cover over the 6 weeks that we have together, we're going to do the overview today. Next week, we'll do Financial Planning 1. The week after that, Medical Care. Week after that, Investment World. For a variety of reasons, mainly my reasons, we're off on the 19th. So then we'll continue back after on this as of the 26th for Equity and Financial Income, and then wrap it up with Financial Planning on November 2nd. So that's where we are at this point.
Okay.
Incidentally, what I'm going to do, since I've just given it to Pete and now taken it back from him, is after Delia comes in, which should be about now, she's going to be presenting with Pete, and I'm going to disappear, and I'm going to be the guy that answers Q&A and chats with you along the way as needed, but I'm going to jump in when needed. Y'all have a good time.
Thank you, Don. Good morning, Delia.
Good morning.
Yeah. Delia and I had started the first workshop 25 years ago. And I was looking for a fee-only fiduciary advisor and to make a presentation to professors at Long Beach State University, and there's also staff. And Delia volunteered, and she's still with us. Now she's doing NPR and Larry Mantle, and she's a friend of teachers and faculty members, and just an all-around good person. So it's great to have you back, Delia.
Thank you. I couldn't have done it without you, Pete.
Yeah, well, it's make a good team. One of the reasons why we started this program is because there is so much sales, selling going on in the financial services industry that most people are not even aware of. And 95% of individuals, when they seek out an advisor, go to someone who is literally a salesperson. And some advisors sell Chevys, and some sell junk cars, and some sell Mercedes, but they're all salespeople. And some dress better than others, and some have degrees. By the way, in order to be a broker slash advisor, do you need a college degree?
No, not, it depends on the brokerage firm, but you certainly don't.
No, you have to be 18 and can sell. That's it, folks. And you can give financial advice after you pass what's called a Series 7 exam. So we do these workshops with the hope that it educates you on how to manage your money and about estate planning. And we toss a little bit of charitable giving in there because we really believe that it's good to give. We're not trying to get you to one organization or another, just to consider a charity, or a mission or a value that you have. And there's just literally no way to pass that on to your kids when you're dead, except by including them in your will or a trust to say what was important to you besides them. We're all in this universe, and it is a community. And so these programs, we don't give away a free lunch, doggone it. We can't serve you wine.
Yeah, no free dinners.
All we can do is kind of give you good educational material. And we give, the idea about money is to stay in control of it. And one of the ways that we want you to think about staying in control is by don't attend one of these free lunch or free dinner programs, because they have your name, address, phone number, and everything else. And you're going to get a call afterwards. And these folks are really good at converting you into a sales. So if there's 30 individuals in the room, 5 individuals will more than likely sign up for whatever they're selling, which amounts to somewhere revenue-wise $30,000 to $50,000. So a free dinner is just cheap, but we're not selling anything, so we're not going to get $30,000 to $50,000. So we have to do it a less expensive way to get you to understand this. But you want to stay in control of your money. And one of the ways to do that is by using the Ask First form. And we talked a little bit about that, Dawn did, but let's pull up your Ask First form, Delia.
Yeah, let me go grab that. I'm going to go grab that Ask First form. Here we go. Let me scroll it up.
Yeah. Everything in the financial industry is about full disclosure, prospectus, ADV. If you as a reasonable person have all the information, then you can make a good decision. It's not always the case. So first thing, we ask about your education. You've had a master's or other advanced degree. What is that?
It's a master's in business administration from Cal State Long Beach.
Ah, no wonder I picked you. And how many years?
Go Beach. Go
yeah.
Beach.
How many years have you been doing this?
29.
29. So you also have, MBA is a credential, and a CFP. What is that?
CFP is something that comes from the CFP board. It is a designation, not a state license, but a designation that shows that I've taken the 8 required classes with at least a B average, that I passed their exam, that I've had at least 3 years of supervision under a CFP before I could use the CFP designation, and that I take 15 hours of continuing ed units every year, and every 2 years I take 2 hours of code of ethics for this.
So CFP, the Certified Financial Planning designation, has some meaning.
It means that we are trained on comprehensive financial planning.
Yeah.
Which includes all areas. It could be budgeting, could be investment management, it could be all the areas of financial planning, such as estate planning, insurance, retirement, college savings. And that we know that those things need to fit together in a comprehensive plan for our clients.
Yeah. There's about 60,000 CFPs in the United States. That makes up less than 1% of investment, quote, people out there. People who have a CFP, and we'll talk a little bit about being a fiduciary, I call those advisors. Other individuals I call brokers, and we'll get to that in just a little bit. You also have you teach the financial planning courses at UCI.
UC Irvine Department of Continuing Education.
Yeah, so it gives you a background kind of as to the new people that are coming into the field. If you ever need a financial planner, and when you live out of the area, Delia would be a great resource for you to make a recommendation beyond her if you need an advisor. Relevant licenses. This is not really a license, it's more of a registration, but everybody who is in the financial services industry has to at least pass this exam. Is that correct?
Well, it depends on the brokerage firm, but these days, a lot of times, more and more brokerage firms are either usually the firm itself is a registered investment advisory firm, because that allows them to charge ongoing fees for assets under management. And that would make their individual representatives under their registered investment advisory umbrella.
Okay. But the important thing is that everybody in the financial services industry has to be registered with FINRA one way or the other.
One way or the other. That's a good way of putting it. One way or the other.
You have to be able to look them up. Let's scroll down a little bit. Business relationship. I will at all times serve as a fiduciary and put your interest before my interest and those of my employer. That seems like, why doesn't everybody?
You'd think. I mean, I'm a career changer. I became the kind of advisor I thought I would want to hire if I ever needed a financial advisor. And I decided to just become one.
Yeah. 95% of the individuals in the financial services industry would have to put false under this line as far as the business relationship is concerned. And many of them don't even know what the word fiduciary means. So
the F word.
Yeah, the F word is correct. Compensation. How do you charge, Delia, and for your services?
I provide services in one of two ways, either hourly, and I charge $3.50 an hour for that. And if we're doing a big plan, I charge $150 to prepare. And it just depends on how complicated your situation is, how many hours we put into it. Or I may manage your assets for an ongoing fee, which typically starts at 1% a year of the assets under management for the first $500,000.
Okay. And then this is a little subtle. It says payment will be made by, and you put down here the client.
And I should have said the client and only the client.
Yeah, I probably should. Only the client. Is that common?
No, not if you're selling product, because you can get commissions for selling a product. You can get ongoing, what they call trailing payments for selling a certain kind of product or mutual fund. It is not that common at all.
No. So that's where that comes in. You hired Joe Schmo, who works for Merrill Lynch. You're not hiring Joe Schmo. You're hiring Merrill Lynch. And Merrill Lynch pays Joe Schmo. So who is the advisor or broker beholden to? Merrill Lynch.
Joe Schmo only gets a certain amount of pay in addition, depending on how much he produces.
Yes, it works like a real estate agent.
Yeah, there you go.
If you work for First Team, you negotiate with First Team how to split that commission when you sell the house. And but they don't work on their own. You work on your own, and do you charge for an initial session?
No, if people want to come in and talk about how we might work together, I'm perfectly happy to do that.
Because that allows you to see what the problem is. It allows a person to see you and see what maybe the fit is not there.
Yeah, maybe not.
Because you have to have rapport. Is that?
Yes, and maybe I can find them somebody who would be a better fit, particularly if they have things that they need help with that I don't have an expertise in. See, that's my job as a fiduciary, is to know what I don't know, either to research it or to refer it out.
And approximately how many clients do you have?
I have about 50 management clients, and then I see several people throughout the year for hourly work, maybe 2 or 3 a week.
Okay. And the typical broker has close to 3,000 clients, just to give you an example. It's impossible to do what's best for them when you have that many. Are you taking any kickbacks from referral fees? And that's what the next question is. It says, hey, you may look good, but are you working with somebody who could be taking commissions?
Yeah, no.
Okay. And she's
my client pays me, and only the client.
Yeah. And then she certifies below that the above is true and correct. How long, I know the first time you ever saw this form, how long did it take you to complete?
A couple minutes. That's not a big
Was
deal.
there anything offensive about it?
No,
No.
it's how I chose to do business.
Yeah. So if you have a financial advisor or somebody who calls themselves a financial advisor, works for one of the major brokerage firms, please give them the blank ask first form and have them complete it. And it's an eye opener. And this is the way I go through and get presenters before they present. This is the information that I want. And I'm fooled sometimes, by, oh, you mean you have a Series 7 license? Oh, you mean you have an insurance license? By the way, do you review people's insurance?
I technically don't give insurance advice, but I definitely look at it. And when I see things that I need to flag, I strongly recommend that they go to their agent, and I give them a couple of things they need to talk to their agent about.
Yeah, we're not going to go through every single presenter as much detail in their ask first form, but use the blank one if you're going to meet with anyone about your money. It's sacred. Money is so difficult to discuss amongst family members. The number one reason for divorce. It's a power play sometimes. Nations go to war over money. I've been involved in estate planning, and when parents die, families break up over the inheritance. It just goes. Love is equated with money. It's such a sacred topic, and I think that's one of the reasons why. And another thing too is there's a whole new area about money called behavioral economics, and they've done study and study and study, and which shows that we're not really, the mind is very malleable and we're not really rational when it comes to our own money because of family history, because of relationships, for a variety of reasons. And so sometimes I don't manage my money at all, my own money, and I've got better things to do. So you may want to consider it, but even if you don't consider it now, sometime in the future, you may. I think the financial abuse is so much on the rise at the present time that, and they target the elderly. And the reason why they target the elderly is because that's where the money is. And so a spouse who's been handling the money is all of a sudden deceased, and now somebody's on their own, and they don't know who to call or what to do. And from scamming phone calls to emails, etc., I'm sure you get those kinds of calls as well, Delia. Save to ask first forms from the fee-only fiduciary advisors, and maybe at some time in the future, you may want to ask for help with your money. There's nothing, we ask help for plumbing, We ask help we don't build our own houses. We don't draft our own documents. Somehow we need to do it ourselves. You got to stay in control of your money, but a financial advisor will help you do that. Let's get into the program, Delia, because we're getting into the introduction and some of the changes that are going on in the world.
Yes. So we have an overview of the financial planning and regulatory process and some tax changes. And this is my information. I'm in Los Alamitos. All right, regulation of investment industry, the financial planning process, and what's new this year in taxes. So we've already started talking about this, right? That there are registered representatives with a brokerage firm, or what we call a broker dealer, and that's like an escrow company that goes between a buyer and a seller of securities or other products like insurance. And advisors may get paid in a lot of different ways, which we've also just talked about. It may be commission, it may be fee plus commission, and they may use the term fee offset, fee based, fee only. Now, I prefer fee only because I think it's pretty clear. And the industry thinks it's pretty clear.
Easiest to understand, takes 5 minutes. If somebody takes 20, 30 minutes to explain how they're stated, walk away. Do not continue. It should be very clean and simple. And
very straightforward.
Average broker charges you close to 3% per year. And you don't see it. It's hidden in the mutual funds. It's hidden in the partnerships. It's hidden in the products that they sell. And so it's, and to explain it takes a lot longer than 5 minutes. By the way, I don't even call brokers financial advisors any longer. You know, the only person I call a financial advisor is those individuals who are a fiduciary who don't sell product. Can you imagine?
I remember when I saw the first large brokerage firm put up a big ad and they said, we have financial advisors. And I'm like, what just happened?
Can you imagine if Big Pharma, all your drugs that you purchased, but you know, your doctor has to sign off on it, but your doctor doesn't get paid for the time he puts in. He just gets paid for the drugs that he delivers to you.
That would be bad.
You know, it's very close to that.
Yeah.
Let's independent versus an associate. What do you mean by that?
Well, there could be somebody who works directly for a brokerage firm, like a representative at Merrill Lynch or UBS, or they could be independent, that they're not tied to any particular brokerage firm, but anybody who provides investments or insurance products or both.
Dependent LPL. That's
yes, there's a yes, exactly. Linsco Private Ledger. If I were that kind of advisor, I might have a relationship with an independent broker dealer where they would enable me to provide securities to my clients.
Yeah.
Mutual funds.
Still have the big wirehouses. That's the brokerage firms: Merrill Lynch, UBS, Morgan Stanley,
American Express.
You know, and then and how do you? Are you going to be talking about? I don't know if you have a slide on this. Who your custodian is and why?
I don't think I did it for me in particular, but I can tell you that it's Charles Schwab, which just purchased my former custodian, TD Ameritrade.
And why
they purchased it a couple of years ago, and now they've done the merger officially.
Okay. And why do you use Schwab as your custodian?
They're very large. They have a wide range of products and services, and I think that they provide my clients with good service when they need to go to them independently. But they provide a wide range of very low cost investment products.
And do you have any influence over that account with Schwab for your client?
Well, I have a limited power of attorney to go in and see the account, to make trades on behalf of my client's accounts, to call the service team on behalf of my client. And if the client approves it, I have the ability to charge my quarterly asset management fees against that account, but the client doesn't have to do that. I have several that just send me a check.
Okay. And if they wanted to fire you, Delia, what would they do?
I just make a call to Schwab. They don't even have to tell me.
And
They could just say, remove her remove her limited power of attorney.
right. Okay. So Schwab is completely independent. Now, what happened in the Bernie Madoff case?
Bernie Madoff said that come invest with my securities firm, and it was really just Bernie Madoff's pocket. It was not an independent firm. It was his own, he claimed his own brokerage firm.
Yeah.
And we think in one part of his business, he did have a brokerage firm, but the part where he was managing people's money, it was completely fake, completely fake.
So you wanted the discount brokerage firms are Schwab, used to be TD Ameritrade, Shareholder Services, Fidelity, Vanguard, you know.
And the key here is that you can go in and look at your account every day of the week, every minute of the day, and see your money. It's your money, as we say.
Yes.
And so it's not Delia Fernandez giving you access. It's the custodial firm, the brokerage firm, Charles Schwab, Vanguard, Fidelity.
Do either of you happen, the question is, do either of you happen to know the fees charged by Schools First Credit Union Investments?
There are brokers, School First, credit unions and banks, I'm going to lump them together, are retail outlets for financial products. So they sell annuities, big annuity sales force. They sell mortgages. They sell car loans. They're a sales office.
So now that I've lit a fire under Pete, what I'm going to say is the fees depend entirely on what you do because they're brokers. And that's the answer we're going to give. And now we're going to let Delia go back to the presentation.
Yeah, you just need to ask them what are the fees, and then you need to ask them what's the total of all the fees.
Yeah, and the common line is that you don't have to pay it. The company pays me. Well, the company pays the person who's selling you the product, but that cost is built in to the product. You know, so yeah, money is sold, and credit unions give you a little better rate on savings accounts and checking accounts than banks do, but they're a business just like every other.
And credit unions can also give you maybe a better deal on a loan in some cases than some of the big banks, because the only way credit unions make money is by lending money to their members or by selling things.
Selling stuff. Okay,
Yeah.
Let's go to the next slide.
All right, so we've talked about some credentials. We've already talked about what a registered investment advisor is, and if somebody works for a firm, like I happen to be a limited liability company, so the LLC is an RIA, then I am actually an investment advisor representative under my own registered investment advisory firm. Technicality. We've already talked about what a CFP is. There's also designations out there like chartered financial consultant in the insurance industry. And we have tremendous respect for somebody who's a chartered financial analyst or CFA. That's like the PhD of investing. 3 years, three exams they have to go through to get the full designation. And otherwise they would present themselves as CFA past level 1, past level 1 of CFA, past the level 2. And then they get to be fully graduated with a full CFA.
The financial services field has more designations than probably any other, because if you have a designation behind your name, you must be smart and you must know what you're doing.
Must be trustworthy.
Yes, must be trustworthy. And so the NASD has on their website a catalog of credentials that most quote unquote brokers purchase to put behind their name and so that they can sell you product. So if you see initials behind someone's name, Google it to see whether or not what they actually had to do to get that designation. And they make it sound that you have to do a lot, but the bottom line is, for most of them, you pay your money and you get your designation.
Well, there might be a couple hours of training.
A couple hours.
I get those emails. Oh, you could be on one of these things if you just take our 5-hour class or a 10-hour
We
class.
guarantee you'll be able to sell more product and therefore make more money. So be careful. Experience. I tell you how important that is.
You know, the more years you have in the business, we hope the more you see and the more you learn. And it certainly does help to have experience in certain areas. So if you have a particular background or industry, like you're a teacher, and so you have some complications with a pension, and perhaps you don't pay into Social Security, you want to ask your advisor, hey, do you know about my kinds of issues? Do you know about this industry? Do you know how this pension and Social Security work or don't work together? You don't need to have your advisor learning on you.
Yeah.
You need to have, it's going to be quicker if you talk to somebody who knows what they're doing.
Yeah, dentists, the aerospace industry, you want to ask, because there's so many decisions that need to be made when you get close to retirement.
Absolutely.
You know, and what kind of pensions are kind of out the door these days, but
there are some government workers who have pensions.
Yeah, and there's also, if you have an experienced individual such as Delia, if she hires somebody new to work with her, then maybe that lack of experience really works in your favor, in the sense that Delia is supervising that particular individual, and you're getting a lot of good service, but maybe not paying Delia's rates. So we need to train new people as well as they come in. As long as they have an experienced supervisor, you should be okay.
There you go. And of course, you want to make sure that you feel like you have a rapport with your advisor and that you can trust them, because it's just like a doctor or anything else. You're probably not going to take anybody's advice if you don't really trust them. And why would you work with somebody regarding your money if you don't trust them? You know?
Yeah, take some time. This is a very confusing area.
Oh my gosh. We have FINRA, the Financial Industry Regulatory Authority, and this is a self-regulatory organization for all U.S. securities firms. And any of us who sell or provide investment advice to clients must register with FINRA under the sponsorship of either independent or a broker-dealer if they actually sell securities directly. But I have to go to a FINRA website in order to update my disclosure form. So
it's kind of like a database for anyone in the financial services industry.
Yeah. The Securities and Exchange Commission regulates the securities industry and registered investment advisors who have more than $100 million of assets under management. And for the rest of us, we are regulated by our states typically. I think there might be 1 or 2 states that don't have direct regulators, but California certainly does, and that's the California Department of Financial Protection and Innovation. And they take care of the securities markets and registered investment advisors with less than 100 million of assets under management.
And why is this important for an individual to know?
Well, what recourse do you have? What regulations do they have to abide by? Would you go to a doctor who didn't have a real MD? Would you go to somebody who didn't have the right to a license to do business? We want to know that somebody's licensed and in good standing with their regulators.
There are people in the financial services business. They have explain what is a disclosure?
Well, it's where you explain and disclose to everybody how you do business, what hours you do business.
No, but in FINRA, you have a disclosure.
What do you, I'm not quite sure how to
In
follow.
other words, when you have a complaint filed against
Oh,
you.
that's very serious.
Yeah, I know you haven't had a disclosure.
Yeah, no, I mean, I have actually helped people go to the regulator and complain.
So
Because some advisors will pose on their website, will pose as if they are registered or pose as if they're in good standing and are offering to give advice for a fee. I've even seen their little PayPal widget on their website, and they're not registered. They're not registered.
So anytime someone says that they're giving financial advice, the first thing you should do is go to Google and put in broker check.
Yeah, I think I've got, I think I had broker check. I thought I had broker check. I think that might be towards the end.
If we go there and you have it, we'll just kind of skip over it.
Sure.
Just
yeah, you want to go to broker check.
Broker check, and it'll get you to the FINRA website. Look them up.
And you need to know that on their own website, we are all required to put it on the first page of our website.
Yeah,
it's a requirement.
And look them up. And a disclosure is a negative.
Yeah, you'll be able to go out and see complaints. You'll be able to go out. They have to show complaints.
And so there's people out there that have anywhere from 3 to 10 disclosures and are still in business. So you got to look them up. Anybody that you are dealing with, please check them out on FINRA. I was with a couple the other day, and they said, Dad has been with this broker for over 20 years, and I'm just going to stay with him. And I said, have you looked them up? We looked them up right there, checked on broker check, has 6 disclosures, all relating to variable annuities. And guess what? Dad had 3 variable annuities in his portfolio. So, you know, she and the nicest person in the world, you know, and that's the #1 reason why people are with their financial advisor. He or she is so nice. I've never met a successful salesperson that was not nice.
I once had a client years ago leave me for another advisor, and then she called in a couple of years and said, can I come back? And I said, well, what happened? And she said, you know, the advisor really wasn't who I thought she was, but I really liked her. And every time she came over, she brought donuts. And I'm like, you know, that was the problem.
I had an insurance agent come over to a lady's house and do her windows.
What?
Yeah. They're the nicest people. Okay. Nice is wonderful. You need the rapport and you want them to be nice, but you can't have disclosures. You got to have some sort of an education, and you got to understand how they're paid. Let's go to the next slide.
Okay. So we've talked about the Ask First form.
Yes.
We took care of that. And now we're talking about the financial planning process.
Okay.
So what's really important for you to sense from your advisor and for you to help the advisor is to understand your personal situation and your personal financial circumstances. We shouldn't be giving one size fits all advice. It has to be for you in particular.
Even for somebody who does it themselves.
Yes.
You got to be able to understand your own money. By the way, according to FINRA and the SEC, we in the United States are 20th in line in the world as far as our public, as far as financial literacy is concerned. So we're right with Zimbabwe as far as financial literacy, because where do you learn about money besides the family or the hard knocks? They don't teach it in high school. They certainly don't teach it in college. You know, you can't learn it anywhere. And these seminars that are given, they're trying to sell you stuff when you're learning this stuff. So whether you do it yourself or you go to someone, you got to understand your financial circumstances. And part of that is the next line.
Yeah, you've got to pick your goals and prioritize them. If you don't know where you're going, you might wind up somewhere else. I once had a client call me, an hourly client. He called me about June or so, and he had a wife and 3 kids. And I said, so what do you really want to focus on? And he says, I've been spending money all year. We do well. He says, but I don't know if I'm spending it on what I want to spend it on. And he was the first person who ever said that to me. And I'm like, he doesn't even know what his priorities are. Yeah. He needed help understanding and selecting and prioritizing what he was spending his money on.
Yeah. Yeah.
I thought it was really interesting.
The number one issue for most people is, as they get older, is the worry and the anxiety of running out of money or having to change their lifestyle because of a lack of money.
So you really need to know what your situation is. And then once we figure out your goals and what's most important to you, then we put together a money plan that helps you make that happen. A course of action, some alternatives, because stuff happens in life, but we also need to know how other ways you can do things.
Yeah. In Don's financial planning booklet, he puts a little bit in there how you can put a balance sheet together.
We're going to look at one of those.
Yeah, or a net worth statement.
That's right.
You got to write it down.
You got to write it down. So we develop the plan, we present the plan, we make it happen, and then we monitor and update and adjust. So here's our net worth statement or balance sheet. That's exactly right. And I had to put this in here because I know how much Pete loves these. I love them too. Yeah. Look at how clear this is. This couple has a certain amount of money that we've divided into savings and investments, retirement accounts, and other assets. The beauty of the savings and investments is it tells me right away where your ready cash is. If you had an emergency, you want to replace that car in the next 6 months. Do you have money set aside for emergencies? This is the category where I get to see it. Right there, that first category.
And most people underestimate their net worth.
Absolutely.
And so you can't it's kind of like not doing a blood test from a medical point of view, and a doctor is going to give you advice, or not taking your blood pressure, and give you.
What do they first do when you meet them? I mean, they tell you to go off and get a blood test, and then they weigh you and they check you out to make sure that they understand what the situation is.
Yeah. And you should update this once a year.
Yes. Yes. And you see how we've got retirement accounts set aside because that's longer term money. We have residence, other assets like your auto, maybe a collectibles, maybe you have a rental property. And then we want to know what you owe because we subtract that from your net worth. And in this particular case, this couple has a net worth of about $1,166,500. $1,166,500.
And I bet you they don't feel very rich.
No, they don't, because if we're getting ready for retirement, we're worried about long-term care. We're worried about, what if the kids need help? Do we have enough? I mean, that's what everybody comes to me for is when can we retire and will it be enough?
Do you have a cash flow statement?
I didn't bring a cash flow statement, but I brought something that shows how taxes work.
Okay.
And I know Pete loves tax planning because it's not what you make, it's what you keep, right? So we have to look at strategies given what your tax profile is. Going back to that analogy as a doctor, I need to know what marginal tax bracket you're in, the next dollar that we make for you, how is it going to be taxed? What's the most tax efficient way to give you advice and implement your plan? So we want to know, are you itemizing or are you able to, you just use the standard deduction? 87% of the people in the country now use just the standard deduction. And they don't even realize it. I have clients come in all the time and they say, well, I don't know if I should pay off the mortgage because I get to deduct the interest. and I pull out their tax return and I said, you're taking the standard deduction. You're not itemizing. Now, in 2 years, when the Tax Cuts and Jobs Act sunsets, maybe you'll get to go back to itemizing, but all tax laws are written in pencil. We don't know what's going to happen, but that section of the law that changed our taxes in 2018 is going to sunset, expire at the end of 2025. Who knows what's going to happen after that?
Yeah. Yeah. It's the standard deduction makes it very easy, but everybody, by the way, there's not one person I've ever met who believes that they're paying their fair share. They all believe that most people believe that they pay too much in taxes. My mother at 98 was paying $1,000 a year in income taxes, and she thought that was abhorrent.
Bless her.
So
Bless her.
all believe that taxes is not something that we want. The thing of it is that we want to strategize a little bit as to how we get our income. So are you going to have some slides on this?
Yeah, let's go take a look. So here's the tax formula. Income from all sources worldwide, number one, although there may be some exclusions. So maybe some things like tax-free interest and things like that you don't have to pay tax, that are not included as part of your taxable income. And then we have deductions for adjusted gross income. We call these above the line deductions. Perhaps you could deduct a contribution to a retirement plan. That's probably the most common if you were making a contribution, a tax deductible contribution to an IRA, for example. And then we have the adjusted gross income, where maybe you get to itemize and maybe you don't. Maybe you have some dependents, and maybe you don't. And then we have taxable income.
So each one of us should know what an AGI is.
Our adjusted gross income, it's used for a lot of things. And then maybe you get some tax credits for something that you did. Maybe you made some estimated tax credits throughout the year, which a lot of people have to do, particularly when they're retired and taking required minimum distributions. And maybe there's some other tax credit. You installed some solar, or you did something else to the home that was eligible for tax credits, or you bought a certain kind of electronic vehicle that gave you tax credits. And then we find out whether you owe money or whether you get a refund due.
And that so far as the deadline this year is going to be October 15th.
That's right. That's right. We all got a break because of the fires.
Yeah. So don't go to your tax person for planning advice and before October 15th, because they're busy doing other individuals' tax returns.
Yeah, they don't want to hear from you.
They don't want to hear from you. But after October 15th, give them a week or two of vacation time. So starting in November, November and December are great months to talk to your CPA and to begin planning for next year. Because if you wait until 2024, then it's too late for it to do anything in 2023. Yeah. So from IRAs to your retirement planning to selling major items, it's, taxes are really can help you, especially if you have a higher income.
Yeah, there's a very hard deadline. That December 31st is a very hard deadline.
Yes.
For that taxable year, the only thing you get to do afterwards is you get to make a contribution to an IRA or other retirement plan that's independent, not work, and you get to do that before you file, in keeping with when you file your taxes.
You have to have, if you have a higher income, please don't do your own taxes. You need somebody who is a specialist to assist you. Let's go to the next slide.
Yeah, you have to think that you may not know what you don't know.
Yeah.
So these are the standard deductions this year, 2023 and 2022. We have them there because we're still filing our tax returns. You can see that they usually go up every year.
So if you wanted to itemize, in 2023, you would have to have over $27,700 in itemized deductions.
That's it. And if you're over 65, add 1,750 to that.
And
Or
remember,
add 1,400 to that, excuse me.
and you're limited to still in California, $10,000 for mortgages.
State and local income tax. It's called SALT. Yeah.
You can't deduct those except for up to 10,000.
Boy, and that's hurt a lot of people, because when our homes started getting so expensive, I remember when people would buy $1 million homes, which was considered expensive then, and they'd say, well, but I can write off the taxes.
No longer.
Yeah, up to 10,000, and that's it. But again, those laws are going to phase out at the end of 2025, and we don't know whether that state and local income tax is going to phase out with it. So,
Yeah.
So here's our ordinary income tax rates, and this gives us, once we figure out after the standard deduction or the itemized deduction, what your ordinary income is.
Yes.
And this is what I know Pete also likes to talk about, because you need to know what your marginal tax rate is. Take a look if you're married filing jointly and you're in between that 89,450 to 197.50. Your marginal tax rate is 22%. That is, the next penny that comes in within those ranges is taxed at 22%. But if you're at the top of that range, the next penny could come in at 24%.
So a lot of times, for example, let's say you were you're married and filing a joint return, and your income for that year is $50,000. That means that you have $45,000 still at 12%.
That's pretty exciting.
That's pretty good. So when you look at maybe how much money should I withdraw from my IRA account, you know, you got $45,000 that the maximum that you would pay would be the 12% on that, which
And
is
on the federal level, that's exactly it.
would not be bad. You got to still consider state, but this is what I mean by understanding your marginal tax bracket.
Because this is such a great opportunity. If you're not yet required to take money out of your retirement accounts, which is where a lot of people's money is, you're not going to, you have an opportunity now to what we call filling up a tax bracket with some of that money and those expenses that may raise your income, but still within the same bracket.
Yeah.
Because once those required minimum distributions kick in, well, you're stuck. That money has to come out and it's taxable. Yeah. Although there could be some strategies you could use. Yeah. So
when you're managing a portfolio, do you manage the tax issues?
Oh, it's very important. In a taxable account, which is where it comes up. In a retirement account, everything happens within the account. You're only taxed when you take the money out. But in a taxable account, from picking the investments, you want them very, very tax efficient, like broad-based index funds, to when we need to pull out cash, we may want to sell some things and sell some things at a profit and sell some things at a loss to minimize the tax impact of selling at a gain. And if we're having a down year, we may take some losses to bank them for future years so that we're making lemonade out of lemons, which is a lot of what we did in 2022.
A lot of people feel like, your charges of 1% per year. Gosh, that's a lot of money. And this is one of the areas where you bring so much value to a portfolio. Can we go to the next slide? Do you do capital gains?
Yeah, this is just an extension of the ordinary income taxes, but then here are capital gains.
Yeah,
this is exactly what you were talking about.
This is where we want to be.
This is where we hope in a taxable account, if we own something more than a year, longer than a year, then we can sell it and get a more favorable federal tax rate. And look at these tax rates. I mean, you could have income married filing jointly up to 89,250. You
And
could
pay
sell some and not pay any taxes.
zero taxes. You know, I tell people that they don't believe it, that's true. The thing of it is that if you own an annuity, can an annuity be a capital gain?
No, you're taking potential capital gains when you put them in an annuity and earning ordinary income. You
So
have no
annuity
choice.
It's totally tax inefficient.
Yes, you are converting, somebody called it converting capital gains into ordinary income.
Yeah, crazy.
I shouldn't laugh, it's sad.
Yeah. Monies that come out of a retirement account, can you make those a capital gain?
No. You can take some of that required minimum distribution and defer it to charity, which is a wonderful strategy that I love to recommend to clients.
You can if it's a Roth account.
Yeah.
Oh, yes, of course. Good point. Thank you. Thank you. If you have a Roth IRA, if that account, which when you made the contribution was fully taxable money, and then you made a contribution, so you got no tax reduction for making that contribution. If the account has been open for 5 years and you're over 59 and a half, then you can take the growth out and the original contribution tax-free. If you don't qualify for that 5 years, 59 and a half, you can always take back your original contribution tax-free.
So what you try to do in a client's portfolio is really work on favorable tax rates. And that's capital gains, qualified dividends, and you avoid churning mutual funds. You use index funds in your investments or ETFs, exchange traded funds, which we'll get into much more later. But the point of this story is, in the overview, your tax rates is really important as to what you get to put back into your pocket.
Yeah, so when people come to me on an hourly basis and I know that they have a brokerage account that they've invested money in, I said, bring me the statement and the cost basis and the gains, the unrealized gains that you haven't triggered yet. And they're like, why is that important? And it's because of this.
Yeah.
Exactly.
You sell an asset, you have to understand the cost basis, the market value, and you pay the capital gains on the difference.
That's it.
And so a lot of it is in November coming up, October and November, you're going to do some tax loss harvesting. What does that mean?
That means you go in and you take a look at whether you have any investments that have lost money. You take a look at whether you've had investments that have gained money. You look at the entire asset allocation, whatever your plan was, see if it's still in balance or if you need to adjust. And when you adjust, what you want to do is do it in a very tax efficient way. You take your gains and you use losses. You sell something at a loss and sell something at a gain so that they offset each other to minimize the tax.
Yeah. And you want
and you're doing that in taxable accounts, not retirement
in taxable
accounts,
not in retirement accounts.
See, the voice of God does help
He
us.
is the voice of God. That's exactly it.
It's
I once
Noah.
I had a client come to me who wanted $50,000 out of their taxable account to put a down payment on a second home. And we went through their account. We sold off some things at a gain and some at a loss. And when the accountants saw the activity that year for their tax return, they got a 1099 that said, hey, here's what happened in the account. She says, oh my gosh, I saw all these trades. I was so worried. There was zero tax impact to those trades. We were able to offset gains with losses, and we were able to get them that $50,000 with no cost.
Huge money is saved. Okay, let's go to the next slide.
Okay, so this is another thing that we want to think about is how much I have people ask me all the time, how much can I give away every year without having to file a gift tax return with my tax return? And this year, that's $17,000 a year per person. So you could stand outside the Rose Bowl after a big game, give each person $17,000 if you wanted to, and you wouldn't have to file a gift tax return with your tax return.
Would you have to pay any taxes?
No.
And what if I decided that one of the people coming out of the stadium, I like them and I want to give them $50,000?
Well, then anything over 17, you have to report under your tax return, and it's added against it's accumulated by the IRS. They keep track against that unified credit amount of how much we can give away during our lifetime or at our death. And that amount this year is $12,920,000 per person.
No
Now, I
tax.
know everybody on this webinar is very worried about that number.
Yeah. Yeah. So yeah, it's if you're not a citizen, make sure that you understand the tax brackets because they're totally different. Also, if you have an irrevocable or irrevocable trust, your taxes are completely different.
Absolutely.
So make sure you get individuals that are self-starters or are an engineer. They think that they can do this stuff themselves. And unless you do this on an everyday basis, it's well worth getting some expert opinions to help you. And it may cost you $1,000 or $2,000, but it's very well worth it.
Yeah. You may not know what you don't know.
Yeah. Let's go to the next.
Okay, so we've been talking about this. Is investment planning, you want to keep an eye on the tax consequences. Look at total return. How much are you getting in appreciation? How much are you getting in dividends and interest? Are you reinvesting those dividends and interest payments? Some people may be a good fit for municipal bonds, which if you buy them in the state in which you live and they're qualified to be tax-free, you're not paying taxes on federal or state income on any of that interest that you receive from those bonds. But maybe you're not in a great tax bracket for that. Maybe you're in that 12% marginal rate. You don't need municipal bonds because they don't pay as well as regular bonds.
Just because it says tax-free does not mean it's beneficial for you.
That's right. Be careful.
Total return.
Yes.
Another one that's really tricky is oil and gas partnerships. They're very tricky as to how you analyze your total return because they can withhold income, yet you have to pay taxes on that income, even though they did not distribute that income to you.
That's why I don't have any of those.
They're very difficult to understand. And your CPA is going to charge you an arm and a leg because they're so hard to figure out.
And if they don't get that tax report, that K-1 out to you in time, then you're
never get them out. You never get them on time.
You have to file an extension.
Yeah. And please don't own tax-free muni bonds in your IRA account or an annuity in your IRA account. It's one of the first looks when we look at a portfolio and say, okay, you've got a salesperson as your advisor.
That's it. That's it. Because an annuity is already tax deferred. You're not taxed on it until you take the money out. Same thing as a retirement account.
Yeah.
So why are you putting a tax deferred vehicle inside a tax deferred vehicle? That makes no sense.
If you own a regular mutual fund, why should you be concerned about distributions?
Because mutual funds are required by law that whenever they buy and sell things inside their fund, if there's any tax impact, and we've been talking about gains from selling something, they push those out to the shareholder. They don't keep them themselves and pay the taxes. So here you are owning a mutual fund that you've never sold throughout the year, but they issue thousands of dollars of capital gains to you that you have to pay taxes on because that's what a mutual fund has to do by law. They push them out to the shareholder. Now, it doesn't affect you if it's inside a retirement account, but if it's inside a taxable account, you have to pay taxes on it.
It's a good reason to own a index fund or an ETF, but we'll talk about that much later.
Yes.
Investment location. What do you mean by that?
Well, so those mutual funds that are actively managed that issue all those distributions, we put inside a retirement account. We may love that mutual fund. It may do perfectly exactly what's needed for that client. And let's let it issue all of those gains inside an IRA where we don't have to pay the taxes until we make a withdrawal from the account. You don't put them in a taxable account. In a taxable account, we're looking for something that's very tax efficient, a broad-based index fund. If you own individual securities that you're not trading, that might be a good place to put something. Bonds that are taxable, that throw off a lot of taxable income, we may put those in a retirement account. Maybe municipal bonds, if it's a good fit for you in your tax bracket, maybe they go in a taxable account. So it's not just what you're invested in, but what kind of account you put it in.
What about annuities? You said beware.
I'll tell you something, the one time an annuity might help somebody is that if somebody doesn't have a pension and they'd like to take some of their money and get a regular payment for the rest of their life because they're scared to death of investing in the market, it might be because there are very low cost annuities in the world now that are being sold without commission. It might be that something like that would be a good fit for you.
And you're talking about commercial annuities. You're not talking about charitable gift annuities.
That's correct.
Thank you.
Yeah, but I love charitable gift annuities too. And I've got that in my slide coming up. It might be appropriate for you. Might be. Yeah. So,
but these
you have to be careful.
They're sold based on security. And we make most of our decisions based on fear.
Yes.
And so, hey, you're going to maybe run out of money and these things, we're the insurance company and we're going to protect you. And, don't be allow fear to raise the level of awareness, but don't purchase based on fear. So let's go to the next slide.
And remember, you can always get a second opinion.
Yeah.
So I wanted to make a note that there have been some changes to when we start our required minimum distributions. I think a lot of people, we've all thought about 70 and a half as when we had to start. But now there's a Secure Act 2.0 law that was the new revision was passed the end of December. And it's changing when we take our required minimum distributions. If you were born in 1950 or earlier, then it's 72. If you turned 70 and a half prior to 2020, then that's 72. Between 1951 and 59, it's 73. And now 1960 or later, you don't have to start taking a minimum amount out of those retirement accounts until you're 75. And as I'm sure Don wants to point out, those required minimum distributions are only out of those IRAs where you got a tax deduction for putting the money in. There are no required minimum distributions for Roth IRAs when you own a Roth IRA. If you inherit a Roth IRA, then things might be a little different, but these are for our own retirement accounts.
Yep. People hate taking money out of their IRAs because they're going to get taxed. But understand your tax bracket.
Yeah, it might not be such a terrible thing.
Yeah. It doesn't mean you have to spend it, although, do you ever have to encourage people to spend their money?
Oh, yes. Oh, yes. And sometimes I'll get whiplash. I'll get a younger couple in that are spending quite a bit of money, and then I'll get somebody who's their parents' age. I can't get them to spend money.
Yeah.
I cannot get them to spend money. Yeah. They're just not used to it.
Yeah. It's hard.
And that's how they got that money.
Yeah. If you spent 50 years of saving your money and all of a sudden now, you can only spend it. It's not easy.
No, it's not. And I do want to mention another change in the law that's coming up next year that we don't have complete information on, is that if you had a 529 plan for a child to save for college, which is a tax defer or tax-free way to save for college, those plans that have been open 15 years and more may be converted to Roth IRAs for that account beneficiary, not for you, but for the kid that you open that account for.
So if you're a grandparent, this is a great way to make a gift to your grandson or granddaughter using a 529 plan.
Who knew? I mean, we may all think about doing this. We may have done this, but to think that, some people were afraid they put too much into these plans. Well, now the government has looked at this and said, okay, we heard you. If it's been there for 15 years or longer, you may be able to convert it to a Roth IRA for that child. There's some annual limits to how you do that. There's a lifetime maximum. There's some eligibility requirements. And because all the planners are excited about this, we're waiting for further clarification from the IRS, because this has the potential to be a real opportunity.
And remember, you cannot own anything if you're under the age of 18. Okay? Only at the age of 18 can you own money, property, whatever.
Can you sign a contract?
You can't sign a
Yeah.
contract.
Can't sign
So
a contract.
please don't give monies in your will or trust to kids who are under 18.
What
And
happens then? I mean, you have to name.
what do you
somebody
do
in
if you're
charge, right?
if you are 18 and get a lot of money? There's a little problem there as well.
Yes,
So,
the Ferrari years.
yeah, the Ferrari years. I like that.
Now,
What a QCD.
I love this topic. Listen, for all those clients who are annoyed by having to take money out, required minimum distributions, and they'll come in and they're also giving to charity. And I say, guess what? You can use some of that required minimum distribution and spin it off to charity. And they say, what? Wait a minute. So this amount is going to be indexed for inflation beginning in 2024, which is great. A lot of us aren't giving $100,000 a year to charity, but if you are, hats off to you. There's also this one-time opportunity that's coming up to use a maximum of $50,000 in a qualified charitable distribution to fund either a charitable gift annuity or a charitable remainder trust or charitable annuity trust. Now, I think Pete, you guys who are the experts, it doesn't sound like it's really worth it to put together a
gift annuity may be worthy of consideration of a one-time type of gift. Certainly not a charitable remainder trust or a charitable annuity trust. Hopefully in the future that limit will increase, but today, if you're over 70 years old and you make contributions to a charity, make it from your retirement account. And we'll go through this more later, but it's a slam dunk.
Yeah, I love these.
Because you don't get an income tax deduction because you don't meet the standard deduction limit for most people. So I give all of my charitable contributions out of my IRA. Dawn does the same thing. Delia, I'm sure you do as well.
I love it.
You know, it's
and we have to remember that we can do these. Now, this is where the law kind of split the ages. Your required minimum distribution may be in the future, but these QCDs started at 70 and a half and they've remained at 70 and a half. And you literally have to be 70 and a half.
Yeah.
And once
why they used a half, who knows?
I don't know why.
It's Congress compromise. So,
I
but
have no
if
idea.
you're 70 and a half, please make your charitable contributions out of your regular IRA.
Absolutely.
Yeah.
Absolutely. And you can't make them to a donor advised fund. You have to make them directly out of the IRA to a charity.
Yeah. And remember, some brokers are just not aware of this, so you may have to educate them. Although this now has been in existence for 3 or 4 years, so hopefully they're getting trained.
Yeah, Charles Schwab will give you a checkbook, and Vanguard will say, send us the names of the charities and the dollar amount. We'll send you checks to sign and mail out.
Yeah. You're getting into a sophisticated area. Active versus passive. These are technical terms that people ought to know. What does this mean?
Active speaks to those mutual funds that are trying to buy and sell and beat the market. Passive is the philosophy that says, you can't beat the market. We're just going to buy the market. So maybe that's where you see a Standard & Poor's 500 fund or a total stock market index or total healthcare index. So an active fund.
Are you an active or are you a passive?
I'm pretty passive. I really am.
And the reason for that is?
It's less expensive and it's tax efficient. And it still gives you the same performance in most cases.
So find out. These are an active versus a passive. You have mutual funds that are active versus passive. You have financial advisors who are active versus passive. You need to understand what that means.
Exactly. So, and we've been talking about already the taxation of retirement benefits. You just need to know what your marginal rate is. And when the money goes in, you also need to know what the tax impact is going to be when it comes out. California, good news, does not tax Social Security. And we've already been talking about municipal bonds. So.
But you can have up to 80% of your Social Security taxed on the national level.
Up to 85%, actually.
85%.
Yeah.
So
could be thrown on the pile of taxable income.
yeah. So when you try to figure out your portfolio, you want to take that into consideration, and maybe muni bonds are the best choice for you. You don't know.
And then we've been talking about, we've already talked about this in terms of what advisors are and how they get paid. We've already talked about their credentials. And I want to mention, I'm a big fan and members of both of these because they give me educational opportunities. I'm a big fan of the National Association of Personal Financial Advisors in particular, because this is where fee-only advisors hang out. Yeah. But we also are located with the Financial Planning Association, and these are the websites.
If I ever have to look for financial advisors outside of Orange County, this is where I go. And I pick out, free individuals, and I give them a call and have a phone Zoom interview with them, and that they can help out my trust client who may not live here in California.
Of course. We can't know everybody.
No, but it's excellent organization, and I hope you take advantage of it. We've got about 5 minutes left. Why don't we put our selves on the screen?
All right.
And if you have a personal question, don't hesitate to personally email Delia, and she can answer it. Don, do you want to take over? And
there's a question at the moment that is the first question was digital dollars coming question, and I asked what about that, and the issue is, will our dollar change to digital dollars?
I don't know. I've heard some talk that the federal government is looking at it, but as you might imagine, they have to protect our currency, and you wouldn't want to do that willy-nilly, right?
Yeah. I've heard that Norway is that very few people carry cash, and it's getting that way here, where we don't carry around a lot of cash, and we use our credit cards for that particular purpose. Be careful though on the credit cards. Delia, is credit cards a big issue when you're using somebody's cash flow and looking at their expenses?
Yes, and the difficulty is that people just say, "Well, I put it on the credit card to get mileage, and I don't know what I spend every year. I don't know." And I'm like, okay, this isn't good. We need to know what we're spending.
Yeah.
At least get that report at the end of the year. But it would be really nice, first of all, if you check your credit card every month, you check that statement to make sure that you actually charge those things, and that they weren't fraudulent charges.
Get a bookkeeper. Put it in QuickBooks. If you use a lot, to give you an idea how massive the credit card is. When on campus at Long Beach State University, in the first semester of the year, there is anywhere between 5 and 10 exhibits in the mall where you get your food, of credit card companies offering $1,000 worth of free usage along with a backpack, to get people to start using a credit card.
They're giving you merch.
Yeah, it's just people, it's almost like people don't ask any longer how much it costs. They ask, what is going to be my monthly payment?
Yeah, and that's so wrong, because if you look at your bill, they're now required to tell you, if you pay the minimum, it might take you 29 years to pay this off.
Yeah.
I just can't imagine.
And then with the increase in mortgage rates, just paying your mortgage twice a month, it's amazing the amount of savings that you have, or putting in extra monies on a monthly basis on your mortgage is what monies you save.
Absolutely.
Okie doke. We are hitting exactly at 11:30, so we have timed this very nicely. Thank you. I want to thank all of you for being here. This has been Financial and Estate Literacy. It's Your Money, week 1. Next week, we will do Financial Planning 1. And so have a good time. And as of tomorrow, Pete and I start with It's Your Estate. So you're very welcome to join that one and be a part of it. Delia, thank you very much. Pete, good to see you. Have a good time. And the